Hey everybody, welcome back into Mining Stock Daily, kicking off the new year 2024 with some market commentary with our partner in crime here on MSD's Morning Briefing. That is Mr. Dave Kranzler of Investment Research Dynamics and also the Mining Stock Journal. Dave, MSD, can you hardly believe this? We're going into year 7.
Man, that's gone by quickly.
Right?
I remember when we were sitting in your basement. And
well, here I am. I'm still in the basement. It's a little bit. It's decorated a little bit better. It actually looks like an office rather than just a basement desk on cinder blocks and 2x4s or something like that. You know. So yeah, we're doing okay. Doing all right. So let's kick off this first kind of market update analysis, Dave. I thought what we could do is a little bit of reflection. 2023, what we saw from market fundamentals leading into the moves into the precious metals prices, and then maybe kind of a general conversation of expectations for the new year 2024, what it means for the metals, but also will we finally see a trickle down and a better move into the more volatile exploration stocks, which have just really taken it on the chin for, let's just say, better part of 2 years. But in hindsight, 2023, we've seen a Fed pivot. What did that obviously put fuel on the fire for gold? We saw some buying into the less risky miners, gold producers, silver producers as well late into the new year. Reflecting back on 2023, what was something that maybe caught you by surprise and something that maybe you were expecting to see later into the year?
man, I'm so jaded and so cynical. There's not really much that catches me by surprise. I guess if there's anything, it's the degree to which the stock market bubbled back up. I mean, it's typical when you're in a bear market, and I still think we're in a bear market, even though the indices are doing what they're doing. You're going to have some sharp retraces on the way down. Retraces higher, but they don't last this long. And so, all you got to, you got to follow the money. And if you look in the right places, you can see that the Fed, even though they're slowly reducing the size of their balance sheet, there's other ways that they're injecting liquidity into the banking system. I mean, we saw it in March with that $400 billion that they immediately, the first sign of trouble in the regional banks, immediately injected $400 billion and set up that facility so that banks could tap into it, to cover their deposit outflows. Or now, I mean, especially the regionals, they've been seeing deposit inflows since the summer, because they hiked the interest rate they're paying to be competitive with money market rates, and yet that facility keeps hitting a record high every week. So it tells me that there's liquidity issues behind the scenes in the banking system. And if you look at, everyone focuses on M2, which isn't the real money supply. They hit M3 in 2006, and that's the real money supply, or the closest approximation that you can get publicly. Or you could anyway. But if you look at the base money supply, which I don't know why they don't call it MZM still. They changed it. In fact, they reconfigured how they calculate M1 and M2, if you recall, about a couple years ago. And every time they reconfigure something, it's so they can hide something. But anyway, if you look at MZM, the base money supply, it's been rising, and again, this is off the top of my head. I was looking at the charts last week. I want to say since July, it's been slowly rising. So that consists of bank reserves and currency and coin in circulation. So they don't break it out, but the only component of that that can be rising is the bank reserves.
Yeah. Okay. So I did see we hit, what is it, $24 trillion in debt?
I think 34, yeah.
34.
I guess my point is that, the stock market inflated up the way it did because the Fed's still pumping, liquidity in certain forms, in various forms, into the banking system. And, and that's the reason why they pivoted. Because they pivoted and that really they've just jawboned rates lower, right? Because we got a massive amount of treasuries that have to be refinanced in 2024. And we're talking, 3% coupon treasuries, which if they didn't jawbone rates lower, you're looking at over 4% coupons on that stuff, close to 5%. So that's part of the reason. But also, I think there is a banking crisis that's bubbling up kind of out of sight right now.
Yeah.
And, and
Can we let's go with that, because you wrote that for this morning's morning briefing, which we recorded obviously earlier today. And I wanted to piggyback on that thought here, Dave, because there are some stats that came up in one of the newsletters I get every morning. $500 billion of commercial real estate debt comes due this year. And in 2025, another $500 billion comes due. And it's just absolutely fascinating. Now, where those rates come from, where they were to where they're going to be when those do come due through the year, is going to be something interesting to watch. And how those get refinanced, if they get refinanced, was going to be it's just going to be a lot of juggling. I don't know how they're going to do it. I mean, so this does come back to some sort of, how is this going to lean on the banks? How volatile will those banks be, specifically the regional banks, which we already seen the volatility earlier in 2023.
Yeah, I mean, notwithstanding the fact that the rates are going to be a lot higher to refinance that debt, it's not clear that the market's there to refinance it. But one part of the world of debt that gets kind of lost in the shuffle is all of the debt that was used by private equity companies to do their buyouts. We used to call them leveraged buyouts in the 90s and the 80s, right? Now I don't know what they call them now, private equity buyouts or whatever, but they're highly leveraged, and a lot of that debt is going to need to be refinanced also. And it's not clear that the market's there for it, because a lot of these companies are crap. They don't generate enough cash flow to service their debt.
Yeah.
So there's that. And then obviously massive loads of consumer debt. That is, the default rates are starting to accelerate on a lot of this debt, auto loans and credit card debt, and obviously student loan debt.
Yeah. And a lot of forgiven student loan debt as well. I think I saw when I was on this holiday break. But so this really put fuel for the fire of the gold price, since the fall into the winter of 2023. There is expectations that it's a fundamental great setup for the gold price. Obviously, we know central banks have been buying. To which degree they've been buying is a little bit, we can speculate there. What are the real numbers? We haven't necessarily seen the follow through in the retail purchasing of physical gold. But despite the move in the gold price, it had reached those all-time highs, made another new all-time high, quickly came down. It hasn't necessarily been, the tide that lifted all boats with the gold equities, Dave, because, GDX is still trading like gold's about, $1,700-$1,800 an ounce. But the 2024 does seem like a good setup for the gold equities. What are those tailwinds you're seeing? But also on the back of that, what are those headwinds we need to be watching very carefully as we move into the new year?
Well, first, really quickly, when people say central banks have been buying gold, I like to clarify that it's the Eastern Hemisphere central banks.
Fair enough.
And then, as far as I know, the Western central banks haven't been buying gold. I think the numbers actually are pretty good, because I think they're gleaned from these central banks' publicly released financial statements. The only one that's not totally clear is China's, because we have no idea how much the PBOC is really buying. We don't even know how much gold really goes into China on a monthly basis, because they opened up the port of Beijing for importing gold in 2014, and they purposely said that they were not going to release those numbers because they wanted some opacity in terms of how much gold was going into China. And I'm sure that's because the PBOC is buying more than just the gold that gets produced inside of China.
Mm-hmm.
So, and also the PBOC does not need to, it's the only entity that doesn't need to source the gold that it purchases after it's processed through the Shanghai Gold Exchange. So that's why it's impossible really to track how much gold they're actually buying. In terms of the tailwinds, I mean, I think what just unfolded in 2023 is very similar to what unfolded in 2007 and 2008, only it's worse. And we saw what the 2007, 2008 tailwinds did for the price of gold over the next 3 years, right? And I think we'll probably see something similar, maybe even a bigger move in magnitude over the next few years, because these problems that contributed to the tailwinds, like just the debt alone. And I'm amazed because it's like it's almost like everyone has their head in the sand, and part of that is because the mainstream media doesn't really report on it or report accurately and honestly on it. And so it's just, I kind of think it's one of those things where people would rather just put their head in the sand and pretend it's not there. But it's getting worse. And I was just looking at numbers this morning in terms of the amount of debt issuance. There was an article posted on Zero Hedge that had it broken out. And, it showed how much debt over the last 4 years, the last 2 years, the last 6 months, and the last 3 months. And we're issuing new government debt at a rate of $4 trillion a year on an annualized basis based on the 3-month and 6-month numbers.
And who's buying that debt? Who's buying the debt? That's part A of the situation. Part B is who is buying that debt.
Well, the Fed's got swap facilities with foreign central banks, and I think they draw on that. And I think that's what you're seeing in terms of the foreign participation in these auctions, especially the longer dated ones. I mean, the most of the debt that's been issued this year has been under a year. It's been T-bills because the money market funds are flush with cash, and they're the ones that have been financing it. But when that, as everyone knows, when that reverse repo facility is completely drawn down, it doesn't even need to be completely drawn down. They're not going to be able to issue the quantity of T-bills that they've been issuing since the debt ceiling was removed. So, and that's the question is who's going to buy when they have to start issuing, 7 to 30-year debt, who's going to buy that? So, I don't know the answer to that. And that's part of the reason why I think the Fed is going to have to start printing money again in this year in order to, the alternative is let the market set a rate that'll induce enough entities, and especially foreign entities, to induce them to buy it. But you're talking about much higher rates, especially if the dollar keeps falling.
Yeah. One of the best conversations I think we had late into last year was with Michael Howell, who really is one of the godfathers of liquidity. And he has this thesis that the Federal Reserve will slowly and then rapidly become the first and last purchaser of U.S. debt. Massive amounts into, $8 trillion by the time 2030 rolls around. That will be something to be watching very closely. And I tend to agree with him because if we're seeing some of those, historically, the big foreign purchasers of U.S. debt not coming to the table, if big banks can't come to the table, we're seeing less demand and more supply, somebody's going to have to come in and purchase that. And I mean, why not the Federal Reserve?
Yep. Oh, I agree 100%. I mean, I don't know what the other option is.
Yeah, I don't know what the other
option is. Unless they're not worried about, what the market clearing rate would be. I think you're talking about something approaching 10% at the long end.
Right. Let's talk before the last couple of minutes here, Dave. Let's talk about the exploration equities, the junior mining equities that we love to remind us to remain humble from time to time. We've seen a little bit of a pickup. We're obviously through the tax loss season of 2023 into the new year. There's a lot of incredible values out there, at least in my opinion. Companies that have done a lot of good work that are cashed up despite the volatile markets, have been able to continue to advance projects, good management, good rocks. How are you following through with this on 2024? You mentioned in this morning's briefing, you plan on trading the junior exploration equities aggressively in 2024. So let's follow up on that. How aggressive are you going to be? Because you're pretty aggressive already.
I mean, the beautiful thing about these junior project development companies, I mean, they're especially the ones where the stocks are like 20 cents per share or lower. I'm talking US dollars, so you can do the conversion in your head if you want. I mean, they're basically for the companies that have good projects that have a reasonable to good probability of being converted into an actual operating mine. These are dirt cheap call options with no expiration. I mean, what better way to play a call option than one that doesn't have an expiration? And you're not going to hit on all of them, but you just have to hit on a couple of them because a lot of these. I mean, you get my Money Stock Journal. I don't know if you read it. It's probably boring after a certain number of years, but I mean, I've run through the case for several different junior, 10-cent stocks. I've run through the case for why these things ultimately should be 5 to 10 baggers, like Viva Gold, Cabral Gold. Cabral's actually, it's nearly doubled since the beginning of November. So you're right. I mean, a lot of these micro caps haven't moved yet, but some have made some pretty big moves. I mean, I bring up Hercules Silver, which,
Oh, maybe we should talk about that. I mean, do you have a position?
World War II hit it yesterday.
Well, did you have a position?
Pardon me?
Did you have a position, or do you have a
no,
position?
I missed the move higher. I had subscribers pointed out to me, and I looked at it, and I'm like, I just, I'm not crazy about it. And I mean, they should change their name to Hercules Copper, right? I mean, it's, what moved the stock was a copper discovery. So, I will say, I mean, I'm not as well versed in looking at copper assays as I am with gold and silver assays, but I mean the grade of what they've discovered so far, I mean it doesn't look great. It's not. I wouldn't call it high grade. They've had some high grade hits for sure, and I think the stock, in my opinion, the stock. I actually am profiling. Was it Hercules that I'm? Oh no, Abra. I'm reviewing Abra Silver for the next Mining Stock Journal, but I looked at Hercules yesterday, and the thing about it is, well, first of all, it looks like there's probably a large mineralized footprint on their project property, and if that's being the case, it's going to take a long time to develop that project. I mean, we won't know for years whether or not it's got an economic deposit on it, right? And I think it kind of just got caught up in the hype, and I think a lot of momentum chasers piled into it and drove it higher. And when they saw what they think are disappointing assays, I mean, as you know, when mining companies turn out a lot of drill results, you get inconsistency, right? Because they're trying to fine tune, where the best places to drill are and try and figure out how the deposit sits geometrically in the ground. So, especially in the early days, it's going to be hit or miss. I mean, Delta Resources had the same issue, right?
Yep.
Which, by the way, thanks for turning me on to that, because that's one of my more favorite plays now.
You're welcome. But it's interesting.
And he's a really nice guy. I mean, that one's up 50% since early November. So, I mean, yeah, they're still way down from where they were. at some point in the last 2 or 3 years. But I mean, this is when you want to buy these things.
Right, right. You saw the swift turns that junior exploration can give. What they give, sometimes what junior exploration equities give if they take away pretty dang quickly, and you saw that. But listen, it's exploration. It's a long game. Just because you make one good discovery, and that was a really good discovery, Hercules Silver made with that deep, copper porphyry play or discovery. Now the question is the follow ups here. Listen, it's a porphyry. These are hugely huge mineralized systems. You need more than 5 or 6 drill holes, right, to really understand there. And even if those grades maybe weren't as good as the first ones and the first discovery hole, doesn't mean that they don't exist. It's not this project is not dead by any means. I think there's just
I agree. I mean, it's they're in the hunt and peck process right now.
Right.
Also, when Barrick came in, they put in 23 million Canadian, and that got
quickly,
and that juiced the stock. Now, the thing about Barrick is they've got investments like that in hundreds of companies all over the world. 23 million is nothing to them. They've got 5.4 billion in cash on their balance sheet. I mean, talk about a cheap option for them. And they, when they develop a project, it's really slow and methodical. And so, like you pointed out, if you're going to invest in Hercules, don't chase the price higher, because you're going to have an opportunity at some point to get in at a lower level, and you got to be in it for the long game.
Yeah.
Especially with that type of project.
Absolutely. And I think that was one of the big stories of junior exploration 2023. Like, for as bad as the market was rewarding good discoveries. There were a few companies out there that made big discoveries that the market lashed onto and drove those prices higher. Some of them maintained those at those levels. Others have come back down. But it was interesting that the market, despite the market being absolutely awful, people were paying attention and rewarding good work. So that's nice to see. Hopefully there's follow through.
The other trade, and I would urge the listeners to go through this exercise. Just pick out 10 or 20 junior microcaps and run like a 2 or 3 year daily chart. And they almost all look similar, where they were up here, came down pretty quickly, and then just for most of 2023, they flatlined. And so that kind of tells me that a lot of these stocks kind of found a bottom, and the selling, the majority of the selling's done. And so all it takes is a trigger point to get capital to flow back into these things really quickly. And I also want to make this point. So over the course of the 22 years I've been involved in this sector, usually the best moves in the sector overall, the highest quality moves, meaning the largest percentage moves that last more than 6 months, that last a couple years or longer. I mean, you could actually look at 2001 to 2011 as one big move with some volatility in between, right? But the highest quality bull cycles in this sector occur when you have gold and silver taking off first, and the mining stocks lagging, but then the large caps starting to move, and then the mid caps, and then the micro caps. And that's kind of what we've seen so far.
Yeah.
Because pull up a chart here. I was kind of surprised when I looked at it. I mean, if you look at, again, I'm looking at a 2-year daily. We've had an upward trajectory in the price of gold since the beginning of November 2022. And that might be surprising, because there's been plenty of volatility in between.
Oh yeah.
And silver has been in an upward trajectory since the end of August 2022. And that, again, just look at the chart. I'm not making stuff up. So, and then if you do the same thing for GDX, GDX has been in an upward trajectory since the end of September 2022, but it's been in a more shallow trajectory. Gold's been in the steepest trajectory, then silver, then GDX. So that's kind of following, the formula I've observed over the years for the creation of a healthy bull move. I mean, you could argue, even though it might not feel like it, that GDX has been in a bull move since the fourth quarter of 2022. And I'm sure people would argue that with me, but just look at the chart. So the thing about it is, the other thing that happens with these junior micro caps is like everyone has their portfolio, their favorite ones that they're invested in, and then all of a sudden you hear about something like Hercules Silver that goes, I mean, that thing was at 4 cents at one point, and it hit $1 quickly. So, and they see stuff like that and they're like, oh, my stocks are just in quicksand. They're stuck in the mud. Well, to me, it's kind of like watching popcorn. And I figured that out back in 2002, 2003, where there'd be all these stocks moving, and some of my stocks were just, frozen. And then all of a sudden, out of nowhere, boom, they would start moving. And they move quickly when they move, as you know.
Right. Yep.
So yes, I think that's probably what we have to look forward to, at least in this year. And who knows how long it could extend into.
Yeah. All right. Dave, thanks so much. Good to see you. Happy New Year. Let's hope that maybe 2024 is just as good, if not better, for the gold price, but maybe a lot better for the junior explorations market, because, like I said, there were some winners in 2023, but the market was not favorable for most of the companies. It definitely feels like the fundamentals are a little bit better moving into the new year. Thanks so much for your time, and thanks so much for your help on the pod, and we'll talk to you again soon.
Sounds good, Trevor. Happy New Year.